This is Nightly Business Report with Bill Griffith and Sue Herrera.
Stampede after the Bulls enjoyed a record 1,000-point day yesterday. They raced to Wall Street's rescue today, wiping out a 600-point loss in the final hour. Active or passive in times of extreme volatility, which is the best path for investors? And tech forecast. The group that led the market higher has taken a beating over the past few months. What might be in store for the sector in 2019? All that and more tonight on Nightly Business Report for this Thursday, December the 27th. And we do bid you a good evening, everybody, and welcome. Sue has the night off. Boy, it was a comeback for the ages on Wall Street today. Following yesterday's record 1,000-plus point gain for the Dow, stocks fell first thing this morning, in part on reports that President Trump was thinking about an executive order banning U.S. companies from using equipment built by Chinese firms Huawei and ZTE. You sprinkle in a drop in consumer confidence, and you had a recipe for a sell-off, which we did have for much of the day. The Dow hit its low of the session a little after 2 p.m. Eastern time when it was down more than 600 points. But then the epic late-day reversal began, and the buyers piled on in the last hour. Boy, did they. At the end of the session, all three indexes were higher. The Dow and the NASDAQ staged their biggest comebacks in a decade. For the S&P, it was its biggest in 8 years. And it all led to the best two-day rally for the indexes on a percentage basis in more than 3 years. Some stats again. Here are the final numbers, though. The Dow up 260 points, back above 23,000. The NASDAQ climbed by 25. The S&P added 21. And as Bob Pisani tells us now, investors should really be keeping an eye now on January.
There's an old saying on Wall Street, as goes January, so goes the year. That's the January Barometer, one of Wall Street's favorite seasonal gauges. According to the Stock Traders Almanac, it's registered only 9 major errors since 1950 and has been accurate roughly 75% of the time. But in a year when a lot of old saws are not working, this may or may not be the case in 2018. January saw a gain of almost 6%, but the S&P 500 is down in December so far. Regardless, interest for this coming January remains very high because every down January on the S&P since 1950, without an exception, has either preceded a new or extended bear market, or a flat market for the year, or at the very least a 10% correction. Now, the recent history of this January barometer has been a little bit mixed. 2008 was the worst January on record and preceded the worst bear market since the Great Depression. Very accurate. The S&P was down 38% that year. But down Januaries in 2009, 2010, and 2014 did not produce negative years, though they did foretell corrections. So that part was right. With a strong track record and so much market confusion around all these economic risks like China slowing and tariffs and the rate hike risk from the Federal Reserve and then the political risk in Washington, it's little wonder that traders are eager to get out of December and into January. But even if January proves to be a down month, there's always a bright side. According to the Stock Traders Almanac, down Januaries were followed by substantial declines averaging roughly 13%, providing excellent buying opportunities in later years. Well, that's a good way to look at it. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, one investment strategy that usually occurs this time of year is tax loss selling. And some of that may have contributed to the market's end-of-year swoon. Leslie Picker explains.
Coinciding with the holiday season is what's called the harvesting season, when investors look for losing positions in their portfolio and sell or harvest them to reduce taxes on capital gains from other investments. It's called tax selling or tax loss selling, and it's a common phenomenon at the end of every year, but particularly this year because there are substantial losses to harvest. Even with yesterday's rally, December's performance in the S&P has been abysmal. It's difficult to know what portion of the sell-off can be attributed to this tax loss selling, but it feeds on itself. The more people that are selling in the market for tax purposes, the more exacerbated the market declines become, experts say. In a down year, this is an even more popular tactic. It gives little excuse to get stuck with big tax bills for capital gains, which is about 23.8%. One advisor says investors should be paying as much attention to tax planning at the end of the year as they are to day-to-day market swings.
Remember, the key to all tax planning is always pay pay taxes at the lowest rates, which is right now. That's kind of like buying, say, buy low and sell high. That's a good one, too.
The deadline to harvest losses for 2018 is December 31st. The question is whether that will put additional pressure on the market in the last 2 trading days. For Nightly Business Report, I'm Leslie Picker.
Certainly the big swings in the market have made for a bumpy ride for individual investors, raising the question again that we raised tonight. Should you be an active investor or a passive investor in this volatile market? Joining us once again tonight, Todd Rosenbluth, who's director of ETF, Exchange Traded Fund and Mutual Fund Research for CFRA Research, which offers investment strategies to institutional investors. Todd, good to see you again. Welcome back.
Thanks, Bill.
So, exchange-traded funds, very popular now, and they came of age during the great bull market that we've been in the past 10 years or so. But it was easy to get into those because the market was usually going up. Now that we're stumbling here to a good degree, why not think about actively managed funds of some kind?
Well, you certainly may want to do active management, but the track record for active managers in 2018 has not been strong. Thus far, we've seen active large-cap funds underperform the broader S&P 500 index, and thus far in the fourth quarter, they've essentially lost as much money as the S&P 500. So there's certainly other ways you could not only just own the S&P through various index-based products, but you could also reduce the risk profile of your portfolio if you're concerned about the latest volatility.
Generally speaking, the active managers have underperformed as the market was going higher, though, but as you go lower, the index funds, the exchange-traded funds have no place to go. You're either in them and the market's going lower, or you have to get out of them to preserve your capital. With an active manager, their job is to try and preserve your capital, isn't it?
It is their job. Unfortunately, sometimes they're successful in outperforming and pulling chips off the table, and sometimes they're not. And this year, they've really done an average job versus the index. And part of the reason that is because that high fee that you pay for active management. So most passive and ETF-based products can cost considerably less. And so if you lose less on the way down by paying more to the manager, that's a good thing for investors.
Now, I know that there are exchange-traded funds and, in fact, index funds that make money when the market goes down. These are inverse relationship kinds of funds. Aren't those a little riskier, though, for the average investor?
They are. So again, you're betting that the market's going to go lower. What may make more sense for the average investor is to focus on lower risk funds, so lower volatility strategies tied to the S&P 500. Invesco offers one, SPLV is the ticker on that. iShares offers a product, USMV. You're getting long equity exposure, but focusing on the least risky stocks within the index. And you're actually down less than you would be not only in the fourth quarter, but also this year using those strategies.
All right. Once again, Todd Rosenbluth with the CFRA Research. Good to see you again, Todd. Thanks.
Thank you.
Meantime, the U.S. oil market has also had some wild swings this year. Prices have fallen 40% just since it hit a 4-year high in October. Has oil, to some degree, become a proxy for the global economy? And is it the key to all of the market volatility that we've been seeing lately? Joining us once again tonight, John Kilduff, the founding partner of Again Capital. What do you think? I mean, we have seen a slowdown in some parts of the world economy, in parts of Europe and in parts of Asia, and oil prices have come down. I know you're seeing a lot of pumping in Saudi Arabia and elsewhere, but how much of it is a slowdown in demand as well?
Well, it's definitely a part of it, Bill. It's been a part of it. Crude oil has been most affected, I think, of all the asset classes by the trade war between the U.S. and China. To the extent China slows down even in the least, it's the key demand center for the oil market, for the oil industry. To the extent consumption there takes any kind of a hit, it's a bad sign for oil. And oil is the first asset to evidence the global slowing out there because it has been so necessary for oil demand growth to maintain even the prices that we had been at.
In fact, Jim Cramer has said, if you want to know where the equity market volatility is going, watch the oil market first. What do you think?
Well, people like to blame oil for all the world's ills, as we've seen over the years. But there's no doubt about it. Again, part of it is a supply situation. There was a big reaction by Russia and Saudi Arabia earlier this year to the Iran sanctions. But We watch a lot of the macroeconomic indicators in my shop, and we've seen them all steadily turn down much more quickly on an international basis. And again, the international field is where the oil consumption equation rests. India has turned down. The rising dollar has squeezed all those economies. They're not getting the price break that we're getting, because when the dollar goes down, they have to translate their currency into dollars to buy the oil.
Right.
They end up paying as high, if not higher, prices than we've seen all year.
Now, the last time you were with us, you were saying that $42 could be a pretty strong support level. We've come pretty close to that here. Is that still a support level for you for the price of West Texas Intermediate crude here in the U.S.?
It is. I like to joke in times like this that it's close enough for government work.
Okay.
Okay, I think the double bottom is in. This is a 16-month low. If you pull out the chart and take a look, this is something that chartists in particular key off of. It held up yesterday, or the day after Christmas.
Right.
And we took another run at it somewhat today. Back over 45. I think that should be it, setting us up now, I think, for some stability in oil prices as we look forward into 2019.
All right. Keep an eye on that as well. John,
thank you
as always. John Kilduff of Begin Capital joining us tonight. Coming up, for a long time, technology led the stock market higher, but the year did not end well for that group. What can we expect in 2019? One expert weighs in. It was day 6 of the partial government shutdown today, and the Senate briefly came back into session, but it still appears that negotiations are at a standstill. Once again, Ylan Mouhi joins us tonight from Washington with not much news, I guess. I mean, how much longer do you think the shutdown lasts? What's the census there in Washington?
Well, it now looks like the shutdown will almost certainly last into 2019. As you mentioned, the Senate opened for business just briefly, about 4 minutes, and then it adjourned until January 3rd before it'll be in regular session again. The same is true for the House, and what that means is no votes are expected until the new Congress takes over. And so this is essentially this current session of Congress throwing up its hands at the hope of achieving any type of bill to reopen the government and ensuring that the next group of lawmakers will have to take this up once the new session begins.
And when that happens, assuming that the president holds fast on his request for $5 billion for the border wall, what is there that the Democrats could offer him to get this negotiation off the dime?
Well, Democrats say they are not going to offer him any single dollar for that border wall, and that is why we're at this impasse right now. I think that Democrats believe what they can offer is reopening the government. That's something that Nancy Pelosi said that she will take up if she becomes House Speaker on January 3rd. She'll bring up a so-called clean short-term spending bill to get the government open again. But right now, the president doesn't seem to be backing away at all from his demands for border wall money. We saw him tweeting just later this afternoon saying that Democrats are playing politics here, saying that Democrats just want to ensure that the Republicans cannot carry forth their agenda. They don't want to give Republicans a win. He said 2020. I'm assuming that was a reference to the presidential election, right, and not to how long this government shutdown might last.
Let's hope not. Ylan Mouhi in Washington once again. Thanks, Ylan. See you later. Plenty of high-profile Democrats are talking about running for president in 2020. Excuse me. Joe Biden, Elizabeth Warren, Bernie Sanders among them, of course. But so far, only one. That would be outgoing Congressman John Delaney of Maryland has actually gotten a head start and launched a 2020 campaign. Now, he may have spent the last 6 years in the House of Representatives, but he does come from the world of American business after co-founding a pair of companies, both of which went public. John Harwood sat down with Delaney to talk about his long-shot candidacy and its origins during his years as an entrepreneur.
Our niche was companies that were growing too fast for their local community bank, but weren't big enough to be served by the big banks. So I built a business to target just that part of the market. It became a good-sized company. We ended up financing 5,000 companies. I took it public. I ran it until I decided to run for Congress. So I spent most of my career helping small businesses get the capital they need to grow, hire people, and pursue their dreams.
What have you learned in the 6 years that you've been in the Congress that makes you think that individually as a person you're ready to be president?
Growing up in a blue-collar family, I've lived the American dream, which is so central to who we are as a nation. I was an entrepreneur, started these businesses from scratch. You know, my dad didn't give me any money to start them. They didn't have any. And I think it's incredibly important that we have a president that understands how the private economy really works and knows how to position the country to be successful. But I've also now...
Do you think we have a president now who understands how the private economy works?
Listen, I don't think the president right now, you know, President Trump, I don't think he's a business leader. I think he was a business promoter. You know, I know what I did as a business leader. I created jobs, I paid all my bills, I innovated, I hired the best and the brightest. I made sure that every relationship I had was as good as possible and that people wanted to do business with me again. I don't think he's really bringing a business person's headset.
Do you want to be known as a pro-business Democrat?
I'm a pro-jobs Democrat, and if you want to be pro-jobs, you to some extent have to be pro-business, because business creates all the jobs in this country, right? So I think about kind of this notion of capitalism and trying to make it more just and inclusive over time.
Do you think the current level of regulation of Wall Street and American business is adequate?
I think in some ways it is, and you know, some ways it isn't. Have we done enough to deal with what's happening with carbon and what that's going to lead to climate change? Absolutely not.
What do you make of the big gyrations we've seen in financial markets over the last several weeks, a couple months actually?
I don't read too much into it. The markets go up and down because of how people think about the future, but also how they think about how things are priced. So I look more at what's happening to people. Last year, the Federal Reserve said that half of our country, if presented with a $500 surprise expense, meaning they wake up, something happens to their car, their house, or their health care, and they need $500, they don't have the savings or they don't have the capacity on their credit card. That's half the country. That, to me, is a much more worrisome statistic than what's happening with the stock market.
After 2020, when you hope to be president, what are the 2 or 3 most urgent things for Democrats to do?
So instead of cutting the corporate tax rate from 35 to 21, if you were to cut it from 35 to 25, which is what the business community asked for,
right,
you could have had $1 trillion infrastructure program.
So you'd like to take that corporate tax rate up a few points?
As part of launching a $1 trillion infrastructure program? Absolutely.
Now, one reason that Delaney started his campaign so early is he realizes he will not have the field all to himself much longer. Announcements from many other Democrats are expected very early in the new year. By the way, for the entire interview with John Delaney, you can go to our website at nbr.com. Apple may be going high-end in India, and that's where we begin tonight's market focus. Reuters is reporting that Apple supplier Foxconn may start making higher-end iPhones like its flagship iPhone X family in India starting in 2019. It would be the first time that Foxconn has made iPhones in that country. Apple was down $1 today to $156.15. Elsewhere, JD.com is reportedly launching an extensive revamp of its operations. The Wall Street Journal says the Chinese internet company is planning to split its primary unit, JD Mall, into 3 business departments, citing an internal document. Shares were up nearly 3% of that company to $21.70 in today's trade. JP Morgan has agreed to pay $135 million to settle claims that it improperly handled transactions involving foreign company shares. The SEC says the alleged transactions occurred between 2011 and early 2015. For its part, JP Morgan said it is pleased to have resolved this matter, which is related to an industry practice the company voluntarily ended a few years ago. JP Morgan shares rose 1% today to 97.04. Meantime, communications products maker Plantronics is going to pay $36 million to settle foreign bribery allegations involving its Polycom unit. The alleged violations occurred prior to its acquisition of Polycom earlier this year and before a transaction that took Polycom private 2 years ago. Plantronics fell more than 4% today to 32.33. Visa is buying British payments firm Earthport for $250 million. Earthport specializes in international transactions for banks and businesses. Visa was up more than 1% today to close at 132.01. And Boston Scientific has exercised its option to purchase the remaining shares of heart device surgery device maker Millipede. Boston Scientific had originally taken a $90 million stake in Millipede in January with an option to buy the remaining shares for $325 million. Shares gained better than 2% today to 34.48. Well, it was a rough year for some of the biggest names in technology. That goes with us saying the sector led the market higher certainly for several years, but it has taken a brutal beating over the past few months. Can we expect more of the same in 2019? Joining us tonight, Paul Meeks. He's the lead portfolio manager for the Wireless Fund. Paul, always good to see you. Thanks for joining us tonight.
Good evening, Bill.
First of all, why do you think we've seen such weakness for technology lately, and do you see it happening more in the new year again?
So I'll do the second part first.
Okay.
I actually think technology stocks may trough. I don't know exactly when, Bill, but somewhere in the beginning of 2019. I would expect once we get to a year from now, December 27th of 2019, the S&P will be having a pretty solid year. And tech, if it's not the top sector among the 11 performers, it'll be pretty close to it. So I am expecting maybe it gets a little bit worse before it gets better, but I'm expecting some better tidings for tech as we look out into next year, particularly the second half of next year.
But are we looking at a slowdown in demand? That seems to be the problem here, the problem for Apple, a problem for a lot of the chip makers out there, that there's a slowdown overall in demand for those products. Is that what you're seeing here?
There clearly is a over-inventory situation of a variety of semiconductors. And of course, semiconductors and semiconductor capital equipment, Bill, are big areas within tech. And of course, tech drives the whole economy. What happens, I believe, is not necessarily prolonged poor demand, but once we winnow down this inventory, and I'm thinking about the summer time frame,
right,
we should be in a better position where demand is equivalent to supply, and we will be past the worst of the problems in semiconductors and thus the tech sector.
Now, I know you're not quite ready to start buying at this point, but when you do, you are going to look at some of those chip companies, aren't you?
Yes, sir. One of the things that is very interesting is the semiconductor and semiconductor capital equipment companies are very cyclical. So they've led this move down, and they will lead the move back up. And so some of them are coiled springs for a rebound, as I said, within a couple of quarters. I particularly like Micron, ticker symbol MU, over the long term, NVIDIA, NVDA, NXP Semiconductors, NXPI, Advanced Micro Devices, AMD. I think they will all do very well in 2019.
I've joked, and very quickly here, the last few guests we've had love Apple. Do you love Apple yet?
You know, I think Apple becomes more interesting at about 140 or so, so a little bit further down.
Okay.
And frankly, at that point, I put it in a high dividend portfolio. I don't think it deserves to be in a growthy tech portfolio.
All right.
Not now, and probably not in the future.
Paul Meeks with the Wireless Fund. Happy New Year. Thanks for joining us.
Thanks, Bill.
Speaking of tech, up next, a new technology hoping to break through in the world of home fitness. Could it be the end of the line for Sears? CNBC is reporting tonight that the 125-year-old department store chain might be forced to liquidate if no bids come in to buy the company by tomorrow. CNBC says Sears' best chance of survival is a $4.5 billion proposal from its own chairman, Eddie Lampert, to buy the company out of bankruptcy through his hedge fund, ESL Investments. Although the network says that ESL is the only party offering to buy all of Sears, but as of today, Lampert hadn't actually submitted that bid or come up with the financing. Finally tonight, as we approach the end of the year, thoughts are generally turned to resolutions, and one of the most popular is getting in shape. Well, now you can train at home like an athlete thanks to a new technology that's attracting some big money. Eric Chemi takes a look.
It may look like just a mirror, but this mirror could change the way you look. A mirror with a built-in video screen that has instructors leading exercise classes.
We're going to start off with some lunges. I want you to step that right foot back, touch the ground.
Bryn Putnam is the founder of Mirror and a former professional ballerina. She says that Mirror is catching on among professional athletes.
Many of them are using it for off-season training, and they're exploring types of fitness that they might not otherwise do in a public setting. So you have baseball players taking a yoga class for the first time.
The product costs $1,500 up front, plus a $40 monthly subscription for unlimited live and on-demand classes. It's a similar model to those Peloton spinning bikes in people's homes, but here the workouts can be anything, including yoga, Pilates, boxing, cardio, strength, and stretch. And another option in the $83 billion per year global fitness industry. Athletes like Katerina Yamashikova, an elite marathon runner who is balancing motherhood and pregnancy, who needs the flexibility to prepare at home for the upcoming Olympic trials.
It's refreshing to run outside, but you still need to maintain your core, your strength, so that you can do at the convenience at your home and you don't need any gym membership.
The company's founder sees pro athletes as just one dimension of the product.
We've already been in contact with a handful of sports teams about the ability of integrating the mirror into their training facilities, but I think everyone's excited about the prospect of connecting athletes to trainers outside of their immediate geography.
For amateur athletes like me, whether it's doing a weights routine or even some kickboxing, I found the mirror a fun way to squeeze in my morning workout and get my heartbeat up.
We didn't build the mirror as a call for people to cancel their gym memberships, but we are finding increasingly that our mirror users are able to get a better, more convenient, and often lower cost option via the mirror at home than they are through the studios.
For Nightly Business Report, I'm Eric Chemi.
We need to get him a workout outfit of some kind. One more look at Wall Street today, a big comeback day. The Dow was down 600 points at one time, finished up 260. The NASDAQ up 25, the S&P was up 21 points. Big day for the day, and we'll see what happens tomorrow. That is Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching, everybody. Have a great evening. See you tomorrow.